CNQ is a heavyweight in the Canadian oil and gas sector, and with a looming 25% US tariff, we have to ask if they have the fundamentals to weather a trade war. Fasten your seatbelts, folks. This is going to be a good one. Canadian Natural Resources is one of Canada's biggest players in the energy sector, with a looming 25% tariff on all Canadian imports to the US. CNQ is facing a massive challenge that could redefine their future. Will they sink or swim once those tariffs hit the fan? CNQ is a leading independent energy company based out of Calgary, Alberta. The company operates in all phases of the oil and gas life cycle, including exploration, production, and development, with operations spanning crude oil, natural gas, and of course, those oil sands. Without a doubt, CNQ is a diversified powerhouse in the Canadian energy landscape. Some of the key advantages that definitely make them a favorite amongst investors include their integrated operations. CNQ boasts one of the most diversified portfolios in the energy sector, with assets in conventional oil, heavy oil, oil sands, and natural gas. This diversification, it definitely helps them mitigate risks tied to, of course, price volatility. Also, they are a low-cost producer. Their ability to produce oil at one of the lowest costs in the industry provides a significant competitive edge. Finally, CNQ has a history of consistent dividend growth, making them a favorite among income-focused investors. Of course, they do have two major disadvantages that we need to talk about as well. First, they have a high exposure to the oil sands. While lucrative, oil sands production is costly and heavily scrutinized for its environmental impact, which it could invite stricter regulations depending on which government's in charge. Second, they have a heavy reliance on U.S. exports. Nearly 90% of Canada's energy exports go to the United States, making CNQ, of course, very vulnerable to shifts in trade policies. That, of course, takes us back to that 25% tariff. What will be the impact of a 25% US tariff on CNQ? A sub to the channel is a tariff-free way to enjoy future content. The US government's decision to impose a 25% tariff on all Canadian imports has sent shockwaves through the entire energy sector. For CNQ, this could result in a few impacts to their business. First of all, we're looking at increased costs. A significant chunk of CNQ's crude oil is exported to the United States, where refiners depend on Canadian oil for heavy crude supply. The tariff would directly raise the cost of these exports, potentially slashing CNQ's profit margins. This then leads to a decreased demand. Higher prices for Canadian oil could push U.S. refiners to seek, alternative sources. And if they do that, of course, that reduces the demand for CNQ's products. These tariffs will also lead to a competitive disadvantage. US-based energy companies could gain an edge as they're not subject to the same tariffs, making CNQ's offerings less attractive. This can also lead to, of course, stock volatility. As these challenges unfold, we could see heightened volatility in CNQ share price, making it a trickier play for investors for sure. These really don't sound great for CNQ, but do they have the fundamentals to weather that tariff storm? To find out, we need the tamer of tariffs, the prince of percentages, the one and only Mr. Math. We will start off with a little bit of their surface data. At the time of recording, their current value is coming in at $44.53. And they have a market cap of 91.71 billion. That beta coming in at 1.88. So that means they are 1.88 times more volatile than the market average. Their earnings per share coming in at 3.52, and their price to earnings ratio 12.33. If we took an average amongst their peers, that would come in at 17.4. Now, a few of those pairs include ARC Resources, which has a PE ratio of 12, Torlamine, which has a PE ratio of 16.1, and Prairie Sky Royalty coming in at 29.4. Looking at their price to book ratio, that's coming in at 2.38, and their return on equity, 19.10%, Those return on assets, 8.21%. Their surface data looks great, and there really are no concerns there for sure. Okay, let's peel back another layer and take a look at their cash situation. Their revenue comes in at 35.42 billion per year. Their earnings coming in at 7.08 billion. Those earnings are projected to grow by 5.01% per year. Their profit margin coming in at 21.3%. They've got a nice looking free cash flow. That's coming in at 8.84 billion. And their operating cash flow also pretty nice looking, 14.26 billion. Looking at their fair value, their current value is coming in at $44.53. Using a discounted cash flow model, we get a fair value of $90.48. That does paint them as undervalued by 50.8%. Looking at their 1-year target, analysts are predicting $55.76. That's a nice looking increase of 25.2%. They have a very healthy cash flow, and this will come into play when it comes to weathering those tariffs. I will also add that the projected growth over the next year, it will temper back if those tariffs persist. Okay, let's turn the page and jump into their returns data. We'll start with their dividend. They have a yield of 4.716%. That is a quarterly dividend of 56.3 cents per share. Payout ratio on that, 59.03%. And that 5-year average dividend increase coming in at 33.33%. That's not too shabby, that's for sure. Switching to their returns, on their 3-year return on investment, that comes in at 39.72%. Factor in the dividends, we get a total return of 57.92%. On their 1-year, that return on investment, 9.84%. Add in the dividends, we get a total return of 15.15%. The 3-year annualized, that is coming in at 19.76%. These returns are fine. And they are a little down from what we are used to with CNQ, as the sector has been in a downtrend for much of 2024. The sector is definitely expected to improve in 2025, so the next year could be fun. Okay, let's take that last jump and take a look at their debt data. Their total debt is coming in at 10.03 billion, and their total equity, this is nice, 39.90 billion. That's a debt to equity ratio of 25.1%. I will say, in the last 5 years, they have crushed their debt to equity ratio down from 64.6%. That is pretty awesome. They also have some cash and cash equivalents of 721 million. Okay, let's take a look at the short term. They have assets of 6.78 billion and liabilities of 8.03 billion. I'd love to see those liabilities come down a little bit, maybe just below that 6.78. On the long term, we got a much rosier picture. Their assets are coming in at 68.31 billion, liabilities 27.16 billion. Overall, this is a pretty good debt situation for CNQ, and that bodes well for them in an extended tariff scenario. It goes without saying that they have a great looking cash flow that can cover the debt as well as the servicing of said debt. I will point out that there's also been no significant share dilution in the last year. I think we have enough data for that final verdict. Normally, the question is if the stock in question is a good investment. CNQ is certainly that, as they have solid fundamentals and they are without a doubt a good long-term investment. I like them so much, they're in the 0 to 100K challenge, and this month I did actually add to that position. The question we did ask at the top of the video was if CNQ is ready for US tariffs, and what is their prospect in a long-term trade war? The 25% tariff, without a doubt, presents a significant hurdle for CNQ. Their strong fundamentals and cost-efficient operations may help them weather the storm. However, the path ahead will depend on how quickly they can adapt to these challenges and whether we get a resolution sooner than later. When all is said and done, and we emerge on the other side of those tariffs, CNQ will be just fine and ready to bounce back as an investor favorite for sure. If you are interested in CNQ, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on Harvest ETFs. Thank you for watching, and I will see you in the next video.